Peter Lynch averaged an incredible 29.2% annual return for 13 years as fund manager of Fidelity's Magellan fund, consistently beating the market and outperforming even legendary Warren Buffett using his buy only what you know strategy. Now, aside from generating incredible returns, Lynch was generous enough to provide countless timeless insights that we can apply to invest successfully in 2024. I'm Marcus de Maria, multi-millionaire and founder of Investment Mastery. I have over 23 years of stock investing experience and have been teaching proven investing strategies for over a decade. Now, in this video, I want to share Lynch's strategies to help you build long-term wealth just like he did.
People have natural advantages.
Yeah.
Let's say what you do for a living is you're involved in the restaurant industry.
Right.
You supply paper products. You supply kitchen equipment. You help build restaurants.
Right.
You saw McDonald's. You saw Chi-Chi's. You saw Chili's. You saw Cracker Barrel. You saw Dunkin' Donuts, Kentucky Fried Chicken, Taco Bell.
These are all success stories.
These were 40-fold. You made 40 or 50 times your money. You don't need to make that kind of money many times in your life, right?
Yeah, no.
That's all you had to do was follow the restaurant industry.
Lynch accomplished his outstanding track record by rigorously researching companies and investing in those that he completely understood, whilst paying close attention to themes and trends happening in everyday life. He was famous for gaining investing inspiration just from walking around the shopping center and observing which shops and products were popular. And this ability to turn day-to-day observations into successful stock picks earned Lynch his reputation as a legendary investor. Much like Benjamin Graham, Lynch believed that with a bit of focused work, normal investors could beat the market performance by some measure. And what's really interesting is that the great Warren Buffett, who also studied under Benjamin Graham, agrees with Lynch. And I just love that. I personally find it very encouraging that both these all-time great investors, the best in the business, right? They share a belief that normal people like you and I can beat the market just by spending a little bit of time and effort researching the market. So, how did Lynch research his stock picks? Well, according to Lynch, he could tell within minutes whether a stock was worth investigating further or not, based on the story behind the company and its growth prospects. He would quickly disregard those companies lacking long-term potential. The key pillar to Lynch's strategy was to understand your investments. See, most people don't.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say, the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it.
Does that ring a bell? Those are very close to the words Warren Buffett uses when he says, I only invest in my circle of competence. Who learned it from whom? I guess it doesn't matter, right? The key is not investing in hot trends or buzzwords you may not fully grasp. Instead, stick to companies that you have personal experience with and understand inside out. For example, if you work in the restaurant industry, you will have an edge when investing in popular dining and fast food chains that you observe doing well. Maybe I wouldn't, but you would. Or if you work in retail, you will have an edge when investing in fashion brands. So take advantage of the knowledge that you already have. Now, earlier I said that Lynch was famous for gaining investing inspiration, remember, just from walking around the shopping center and observing which shops and products were popular, right? Well, in fact, Lynch is famous for this quote: if you love the store, you will love the stock. Now, often it was his wife raving about some new shop or product that she just visited, and that chat with his spouse would become the spark for Lynch's research. So not only did he find out what was doing well, he was also months or even years ahead of Wall Street, buying those stocks early before they caught on more widely. So the key here is identifying standout companies poised for massive growth in the years and decades ahead before Wall Street, if possible. Think about well-known stocks today like Amazon, Netflix, Nvidia, Apple, Microsoft, Google, etc. that have grown earnings tremendously over the past 10 to 20 years. Those are the types of big winners that Lynch sought out early on before they became household names.
But you have to look at 20 to find one. It's just you don't go to the mall and find the stock. I mean, you have to say, my God, this sounds like it's good. And then you have to do some steps. You have to do an organized method. People are careful when they buy a toaster. They're careful when they buy a seat. They do some research.
But they don't do it with stock. They call up the broker, or they see somebody at lunch and they say, man, I got this hot stock, and you run right out and you spend $5,000, small investors.
Yeah. Or even worse, they put an option in International Data WAC. They don't even own International Data WAC, so they have a 90-day play.
But Bill said it was good and they make a lot of money.
Right. And it's like a casino.
Yeah.
So it's like a casino. You get the same results as if there's more paperwork.
Right.
This type of research is how Lynch consistently uncovered winning stocks long before the crowd caught onto them. I'll give you some examples. In 1986, Starbucks was just a small Seattle-based chain, but it still had 11 stores, right? So it's not a startup. Peter Lynch has not confirmed investing in Starbucks at that early stage. However, it would have aligned with his strategy of investing early in disruptive, up-and-coming companies before they became well-known. And in his book, One Up on Wall Street, I tell you, this book is great. Lynch cites Starbucks as having strong fundamentals and management and advocates generally investing in disruptive companies, a description fitting young Starbucks. This type of research allowed Lynch to consistently find winning stocks early before they caught mainstream attention. Lynch was an early investor in dominant stocks like Dunkin' Donuts, Subways, and Home Depot, recognizing their incredible growth potential before their stocks skyrocketed. So, the lesson here is to make sure that you keep your eyes peeled for up-and-coming companies like these with game-changing potential still under the radar. Unlike traditional buy-and-hold investors holding forever, Lynch also recommended taking profits once your growth stocks had appreciated massively.
Well, you ought to find out why you bought a stock. If you're saying it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. And that's what I do with the company. And that's your decision. That's how you sell it.
The key is not getting caught up in hype and euphoria over a stock. Always pay attention to the company's fundamentals and sell when the story begins to deteriorate, i.e. when the fundamentals are no longer as good as when you bought them. Because as Peter Lynch famously said, there's no shame in losing money on a stock. Everybody does it. What is shameful is to hold on to a stock, or worse, to buy more of it when the fundamentals are deteriorating. And this quote from his book, One Up on the Wall Street, published in 1989, but still so relevant, highlights the importance of staying rational and sticking to the fundamentals rather than averaging down or clinging to losers based on emotion. Nothing wrong with buying more, but not based on emotion. When the facts change, it's crucial to acknowledge and move on swiftly. Another thing that makes Lynch unique is the sheer number of stocks he owned. You won't believe it. At its peak, the number of stocks in the fund reached as high as 1,400. That's insane. This wide range of investment across various sectors and industry was actually pivotal in reducing risk and profiting from growth opportunities across the market. I personally think that this makes his performance even more remarkable. On the other hand, holding so many stocks, I guess, could also have been an advantage, right? Because Lynch's strategy included finding what he called the 10-baggers, stocks that reached a 10 times multiple of their original value. So this is interesting. He famously said that as long as you find just one 10-bagger every 10 years or so, you will do very well. Well, I mean, if you're holding a large number of stocks, you're bound to find a few 10-baggers, right? As long as you don't sell too early, that is. Now, let's examine which types of stocks that Lynch consistently identified as having growth potential over his career. In a 2021 interview, Lynch highlighted fintech innovators as a huge opportunity. He specifically named companies like Block and PayPal as disrupting financial services in positive ways. Lynch sees such potential in these fintech players because they utilize new technology to make financial transactions and services way more affordable and accessible to everyday people. So for example, Block, formerly known as Square, provides great tools to help small businesses manage its finances. and PayPal enables super easy online money transfers. And these fintech companies are really shaking things up. And what they do is they force the old school banks and financial companies to totally rethink how they operate. The big traditional players are having to team up or even acquire young fintech startups just to stay competitive in this new landscape. So, in Lynch's eyes, fintech disruptors, and he does mention Block and PayPal, but always do your research, of course, have opened the door to totally transform how finances work. And he believes we're still just in the early stages of that process. Okay, what about biotech stocks? Lynch has been very vocal about his optimism in companies such as Vertex and Amgen, which he highlighted in a 2022 interview. Lynch points to the fact that people worldwide are living longer lifespans. By 2050, around 2 billion people globally will be over 65 years old and will need and want more healthcare and medicines. Additionally, biotechnology science is rapidly advancing. The industry is continuously developing new treatments as people seek to live healthier for more years. With an aging population needing more care, paired with scientific breakthroughs in new medicines, Lynch sees really strong tailwinds for the biotech sector. And that's why he's particularly bullish on growth perspectives for companies like Vertex and Amgen, which he mentions. In a much more recent interview, 2023 with CNBC, Lynch highlighted companies like Clearway, Sasol, and NewLake as examples of how he identifies opportunities by digging into the details of a business' competitive environment, management, financials, and overall potential for expansion and profit growth. So in this CNBC interview, Lynch used those companies, Clearway, Sasol, and NewLake, as examples of investments aligning with his philosophy. In addition, Lynch has expressed optimism for major software companies like Microsoft, Salesforce, and Intuit, which is really surprising because they've had a lot of growth already. You've likely heard of these software giants, right? Well, Lynch has spoken very positively about these companies, seeing huge potential for continued expansion. So according to Lynch, they often have subscription models providing recurring revenues to fuel growth, which is true. And they constantly create new tools to meet client needs. Their products improve as more users join their networks. And with trusted brands, they retain loyal customers. And as companies shift online, these software giants are perfectly positioned in Lynch's view to benefit from providing cloud services, for example, business software, and data analytics. He explains that software is indispensable for phones, computers, hospitals, factories, and pretty much everything. The more it's used, the more valuable it becomes, and it remains essential even during economic downturns as businesses rely heavily on software to operate and innovate. Now moving from software to renewables, Lynch also sees massive potential in this emerging sector. In an April 2023 Morningstar interview, Lynch highlighted renewables as being in the early stages of an enormous multi-decade trend, seeing major growth potential as clean energy displaces fossil fuels. He notes people globally understand fossil fuels harm the environment and health, so clean sources like solar and wind are gaining traction, with governments now even incentivizing their use. Costs for renewables have decreased substantially, making them economically viable alternatives to oil and coal. And new technologies continue improving efficiency. And renewables are also diverse, right? You've got solar, wind, geothermal, hydro. You've got volcanoes. You've got oceans. This mix improves energy security. Clean energy can integrate into existing grids slowly without disruption, especially as storage solutions overcome the intermittency of solar and wind. With surging energy demand from growing populations and business activity, Lynch believes renewables present a sustainable path forward. He sees overlooked niches in this sector offering a huge potential for investors identifying trends early. These are the type of still overlooked and emerging growth niches that Lynch recommends researching deeply to find the next 10 baggers. The key is spotting those trends early and investing in the coming winners ahead of the pack in 2024. As Peter Lynch has not submitted any 13F filings to the SEC and does not appear to be registered as an investment advisor, his current registered and filed portfolio with the SEC is not publicly available or disclosed. However, there is a website, and I'm going to give you the link in the description below, that has created a hypothetical demo portfolio which models what Lynch might be investing in today based on his well-known principles outlined in his books. It's important to note that this demo at peterlynchinvestor.com is not officially endorsed by Lynch himself. So what the creators did is they picked a diverse mix of stocks that they feel align with his teachings across sectors like financial services, food production, property investments, etc. So here's some of them. I mean, you can look yourself, but Arrow Financial Corp, which is a financial services company, Cal-Maine Foods, which is the largest producer of fresh eggs in the United States, First Bancorp, obviously a bank holding company, Lakeshore Bancorp, etc., etc., etc. You can look through the list yourself. There's even some property investment trusts in there, like REITs, for example, and self-storage companies and more. This selection of investments showcases Lynch's continued adherence to his principles of diversification, investing in companies from various sectors such as financial services, food production, and real estate. And as you can see, these companies, they're not exactly blue chips. Yeah, they're not companies that you and I would have heard of and maybe invest in, but they are maybe uncovered and set for massive growth. So, in summary, if you want to have the kind of, let's face it, incredible investing track record that Peter Lynch has achieved, then buy only what you know. Most people don't do that. Find lesser known growth stocks early before Wall Street finds them. They're still public, but they haven't been pumped up. And then cut losses quickly on deteriorating stocks if the fundamentals change. Finally, diversify, hoping to find 1 or 2 10-baggers. What's the most important investing lesson that you learned from Peter Lynch? Comment below and let us know.